Trade with clarity.
You mark a higher high, then price pulls back, so you call it bearish. One candle later, buyers step back in, and suddenly you're bullish again. By the time the real move begins, your chart looks like a conspiracy board, and your bias has changed 6 times. The market didn't change its mind 6 times. You did. And the reason is simple. You're treating every small turn in price like a meaningful trend change. Most of those turns aren't structure. They're noise. A lot of traders use market structure like a prediction machine. They see one high, one low, draw a few lines, and believe the chart has revealed what happens next. That's not what structure does. Market structure is a classification tool. It helps you organize what price has already proven. Is price making meaningful progress higher? Is it making meaningful progress lower? Or is it overlapping in the same area with no clear direction? That's the job. Structure doesn't promise the next candle. It stops you from inventing a new story every time one candle looks dramatic.
Price never moves in a perfectly straight line. Even strong moves pause. They pull back, they print wicks, they hesitate for a candle or two. That doesn't mean the trend has changed. Look at this move. Price pushes higher, pauses, pulls back slightly, and then continues. Those smaller turns may be visible, but they don't automatically carry the same structural weight as the larger move. This is where traders get trapped. They label every internal hesitation as a new event, then wonder why their analysis changes every 5 minutes. Seeing a turn and proving that the turn matters are 2 different things.
Early labels create unstable analysis. Look at this chart. Price is making clear progress higher. Then a small pullback appears. Nothing unusual. Strong moves pause, hesitate, and retrace. But an inexperienced trader sees that pullback and immediately changes the label from bullish to bearish. Now the chart story has changed, even though price hasn't proven that anything structural changed. A few candles later, price continues higher. The market didn't reverse and reverse again. The trader simply reclassified the chart too early. This is why premature labels are so damaging. They make your read unstable. Every small turn becomes a new story. Every pause becomes a possible reversal. And eventually, you stop reading price and start reacting to candles. The goal isn't to defend a bullish or bearish opinion. It's to require enough evidence before changing the classification. Instead of asking, did price turn? Ask a better question. Did price make meaningful progress? These 2 charts both contain turning points, but they don't communicate the same thing. On the first chart, price moves away briefly and then falls straight back into overlap. On the second, price leaves the area and changes the visible shape of the move. You don't need to measure every leg with a ruler. You do need to stop promoting every minor hesitation into a major event. The cleaner the progression, the more useful the information becomes. The more overlap you see, the less certainty you should pretend to have. Here's the answer traders hate most: unclear. They think every chart must be bullish or bearish. It doesn't. Look at this section. Price pushes up, pulls back, pushes down, and then returns to the same area. The swings overlap, and neither side creates clean progression. Calling this neutral isn't weakness, it's accuracy. The trader who can admit, I don't have a clean read, has an advantage over the trader who always needs an opinion. One trader waits for better information. The other manufactures confidence and pays tuition to the market, usually more than once. Another common mistake happens when price breaks a recent high or low. Traders immediately declare a new trend. But look at this example. Price trades above the prior high, creates a dramatic wick, and then returns to the same area. The level was broken, but the structural question wasn't settled. A break only tells you that price traded beyond a reference. It doesn't tell you whether price will stay there, whether the move will develop, or whether the broader chart has changed. A break is useful information. It just isn't the final verdict.
Pull up one of your recent charts and look at every label you placed. Did each one represent a meaningful change in price behavior? Or did you label it because one candle looked different? Did your bias change because price clearly progressed? Or because you became uncomfortable during a pullback? Your chart should clarify your thinking. It shouldn't document every emotional reaction you had during the session. Remove the weak labels. Keep the obvious turning points. And when the chart isn't clear, leave it unclear. You don't earn extra points for having more drawings. This is trading, not arts and crafts.
The goal isn't to label structure early. It's to label it correctly. Start with the chart, not your opinion. Observe the movement. Ask whether price is making meaningful progress or remaining trapped in overlap. Let the obvious turns earn your attention, and let the minor noise stay minor. When the evidence isn't clean, neutral is still a valid answer. Once you stop reacting to every wiggle, your analysis becomes more stable. Your bias changes less often, your trade selection improves, and you give the market enough time to tell its story before you interrupt it with your own.
If your bias keeps flipping during the session, don't blame the market yet. Clean up how you classify price first. Inside the Wolf Den, we build this process step by step, so your chart reading becomes consistent instead of emotional. Subscribe to Arctic Wolf Trading and join the Wolf Den community when you're ready to stop guessing what every candle means.